welcome to this special show, Accounting for Change. It's been over a year since India moved to the Ind AS accounting standards. The transition has been a gradual one, with listed companies having a net worth of over 500 crores making the move in phase one, i.e. the last financial year, that's 2016-17. Now, as phase two rolls out this year, with the scope being extended to all listed companies as well as unlisted companies with net worth of over 250 crore rupees, it's perhaps a good time to take stock of what these new accounting standards have meant for earnings, for balance sheets, and overall corporate strategy. Joining me on the show is Sai Venkateswaran, partner and head of accounting at KPMG India, Gautam Duggad, head of research institutional equities at Motilal Oswal, and MS Krishnan, MD, Thermax Limited. Gentlemen, it's great to have you. Thank you so much for joining in. Of course, Mr. Krishnan joins us all the way from Pune, sir. Glad to have you on the show as well. I'll start with some broad, opening thoughts. And Mr. Krishnan, the first one goes to you, because you as a corporate have actually undergone this transition. How has the change been? And largely speaking, what has it meant for you as a corporate entity?
Surabhi, it was a very well thought out transition that we could manage. Since the government has warned us well in advance, we were fairly well prepared. But it did mean a lot more of changes internally, and the ones which had impacted us substantially are, to start with, we have got two joint ventures, one of them fairly large in size. In the earlier past, since we owned 51% of the equity of the company, we were consolidating line by line of the balance sheet of the subsidiary into the main one, whereas the new accounting standards, it specifies that irrespective of what is the percentage of shareholding that you got, the real control is a factor that will enable you to be consolidating. So that has brought down our overall turnover for the public consumption, but otherwise the status remains the same, but it needed a lot more changes in accounting practice. Second one which had impacted our company was we got a subsidiary of a company by the name of Thermax On-Site Energy Solutions, where we sell the steam instead of selling a boiler. So in a customer's premises, we are keeping our equipment, and we collect a monthly base, based on the consumption of steam from the equipment. But the new accounting standards stipulated that it will have to be converted into a lease rather than an equipment which is remaining on a balance sheet. So this has really meant restating many things for the last year and the current year. And one of the major changes which has impacted contracting and engineering companies in the capital goods sector is something known as expected credit loss, which is the new animal for India. Like normally, when we give a credit to a customer, only when you don't collect the money and when we are really sure about the fact that we are unable to get the accounts receivable, we are going to provide for it. Here, from the day one, when you collect an order, even before you start executing the order, or across maybe 1, 2 or 3 years of execution, you go to every quarter, go through that particular order and predict as to, am I going to be losing any credit in the future and account for it in the current year. It's a very cumbersome exercise.
This ECL animal, as you called it, I think that's one of the things that people will have to grapple with. How do you account for changes in credit quality over the course of the life of a certain instrument? But Gautam, your opening thoughts. I mean, you just heard Mr. Krishnan. So looking at it purely from an earnings analysis point of view, particularly for infrastructure companies, capital goods companies, revenue recognition changing, a lot of the business which is in the form of joint ventures, that recognition changing, is it making it harder to analyze, or how have you changed your approach?
So our approach basically has not changed. From an earnings point of view, obviously the market has a tendency to look beyond these accounting changes and focus on the underlying cash flows. But yes, the job of an infrastructure analyst, I must say, has got a little more difficult. The sheer change from consolidation to equity line-by-line method earlier to equity way of accounting it has distorted some ratios, and to that extent, the debt ratios and consequently the traditional tools of valuation that one has been using, they've been rendered a little more irrelevant. So today, when you do EV to EBITDA or when you do price to book, some of those traditional tools of valuations have gotten a little distorted. But I mean, this is the fact of the life. You have to get on with it. And market, as I said, has a tendency to look beyond these accounting changes and focus on the real underlying business model and cash flow changes which happen.
Okay. Well, we're going to come back to this, the fact that the relevance of certain ratios itself is changing because the standard itself has changed. So, Sai, I want to sort of start off with the analysis that your team at KPMG has done. And Sai's team sort of came up with an analysis across the BSE 100 universe and all the companies that were within the Ind AS threshold in the first year. And interesting trends come up. Now, we know that revenue largely has gone up just because excise duty is part of the top line. Yeah. But if you take that out, what your analysis says is that revenue has actually gone down. Yeah. Run us through some of the reasons behind this.
Sure. So before I get into the specific reasons on revenue, so if you look at the whole Ind AS transition, I think it's probably the single largest financial reporting reform that the country has seen. It makes some very fundamental changes. So one is, I think, the move towards greater use of fair values as compared to a historical cost basis of accounting. And the second is, I think, greater use of substance over legal form, because old Indian standards were more based on the legal form of the transactions, whereas now you look at the exact economic substance of some of these transactions. And thirdly, the new standard kind of fills in some of the gaps that were there in the old accounting framework. So in that sense, I think today we have a set of standards that you can say are kind of comparable with the best in the world because these are aligned to the IFRS standards. Now, coming to your question on revenue recognition, yes, we did see a 4.6% increase in revenues of companies. But if you actually dissect it, there was an impact on account of the excise duty being grossed up under Ind AS as compared to the older standards, which is kind of contributed to close to about 8% of the increase. But if you look at the remaining companies, I think there was about this population of 72 companies in the BSE 100 recorded about 58,000 crores of reduction in revenues. There are two or three key reasons for this. So one is, like Mr.
Onikurishan mentioned,
was talking of
consolidation is just not there now.
The deconsolidation of some of these joint ventures has led to reduction. The other is some of the other transactions now being accounted based on their economic substance. So, for instance, there's a deferral of revenue on an arrangement which has got multiple elements. So, let's say you're selling goods together with services being rendered over the next 2 to 3 years, etc. So, earlier, for instance, you might have recorded revenue based on how you've contracted the values for the goods versus the services. But today, you look at the relative fair value of the two, and you possibly end up with actually deferring some part of that revenue. That's one element. The others, again, some of the items that were getting accounted as part of revenues have now got netted off with costs. So, for instance, some of the sales promotion kind of items, etc., which were previously being shown as part of revenues and with a corresponding cost, but under Ind AS, you kind of knock them off, so you kind of knock off the cost to that extent. And the last is, again, when you have some of these long-term contracts or long-term arrangements, etc., and where you have the payments being deferred over a long period of time. So on the whole, if you look at it on a normalized basis, yes, probably revenue has come down for Ind AS companies. And this excise duty was, again, more like a one-time thing because this year we moved to GST. Under GST is essentially knocked off from revenue, so you kind of present revenues on a net basis.
We'll go back to sort of the previous framework in some ways.
Absolutely.
Because this was just one quarter. Now, the other interesting aspect of Ind AS is how financial instruments are being treated, because as you mentioned, the whole approach is fair value.
That's right.
And I guess there's also the concept of classifying the financial instrument itself,
right.
whether it's going to continue to be treated as equity or whether instruments like optionally convertible debentures or shares, whether they will start to have a debt component to this.
Yeah.
What's the clarity? And increasingly, are we going to see an increase in finance costs like the way we saw in year one?
Yeah, so there are two parts to it. So one is the classification of the instrument, and second, the related impact on P&L. So classification, again, it's coming down to what's the economic substance. So if, for instance, preference shares, previously they were classified as part of share capital, and therefore it stayed within the broader equity. The related payouts were classified as dividends, so went below the line. But today, when you have redeemable preference shares, for instance, it's treated essentially as debt, because the substance is that you've got money from somebody, it's repayable after a period in time. There are annual coupon payments that are paid out as preference dividends, so or as a redemption premium, which is a back-ended payout. So under Ind AS, you essentially kind of look at what is the effective yield on those instruments. So you kind of recognize the cost into the P&L on a periodic basis, and also this amount gets reclassified from your share capital into a liability line item. Similar is the case with a number of other instruments, which you would have certain items getting reclassified from equity to debt, certain others which were previously classified as debt now getting classified into equity. So, for instance, when you have compulsorily convertible debentures, which are in certain circumstances might actually now get classified as equity rather than as debt. Or you could have a hybrid of the two. So when you have some of these, again, optionally convertible debentures which have an equity element but also a liability element, so the liability element gets stripped out, gets treated and accounted for like a plain vanilla debt instrument with the corresponding hit coming into P&L on a equated basis.
So largely speaking, Gautam, how would you look at some of these aspects? Because as he mentioned, with these changes coming through, the element of finance cost expected to go up. But is that something that's pretty much already been discounted now with this changeover?
Yeah, it's been discounted. And obviously, you also have to look at the other angle. There are cash-rich companies where now you have to treat it on a fair value basis. So clearly, sectors like consumer, auto, which have traditionally been very cash-rich, they are seeing jump in their earnings because earlier you used to recognize it on a lumpy basis. Today you have to recognize as you go on a fair value basis. So clearly that is one angle. Secondly, it ends up distorting to an extent the return ratios also because you're revaluing the assets. So your denominator goes up in the calculation of return ratios. So you are seeing reduction in ROCs for some of these companies. So, I mean, one of the examples I can cite is companies like Hindustan Lever and Colgate who have been very cash rich, literally negative working capital. There, the return ratios, which used to be in triple digit or close to 85-90%, they've come down to 70-65%. So that is one of the offshoot of this whole transition. But, I mean, it has not changed the way people look at businesses.
Fair enough. Now, that's on P&L. We need to take a quick break. I'll leave you with the conversation that I had with the CFO at Mahindra & Mahindra, Mr. V.S. Parthasarathy, talking about the transition that a big conglomerate like M&M is making with Ind AS. Take a look.
Let's take Mahindra Finance or Mahindra Holidays. Mahindra Finance would look at RBI regulation as a basis of providing for NPAs and so on. Now in the new regulation, they're saying based on the past and based on the pattern, based on expected losses, you build an algorithm which not only is true for past but predicts the future well. And this algorithm keeps changing as you go forward and gain more knowledge. Or take Mahindra Holidays, we got various kind of, we take money over a very long period of time. And now the ECL has to say that we've got the right kind of debts and balances. There it changes things dramatically and I think positively. So ECL has been a good learning through the IFRS process, which I think will benefit us and the industry. There is one, however, where I am a little bit at difference with what the Ind AS says, and that's subsidiary consolidation. Now what is happening is many of the places we get private equity, and private equity wants rights which protects them, and I would agree with them. For example, they want budget to be approved by them as well, and it's a fair ask, nothing to do with affirmative rights or participative, it's more to protect their investment, they want that. But in the way we define, it's an affirmative right, so you can't consolidate that company. I mean, look at it almost like a father and mother, both of them the child belongs to them, but in case of my Ind AS, you can't consolidate, you can't treat them as part of your family.